market crash, it is very easy to fall for the saying, buy the dip. However, it is during these times that a lot of companies fail the test and go bust. So while buying the dip is a great strategy, it is subjective to the company that you're buying. In this video, I will teach you how to manage your portfolio and share with you 8 ways to identify dead companies walking and avoid them. Hi, my name is Neera and I'm a financial analyst. I talk about personal finance and investments and teach you how to make money and grow it exponentially. If you're interested in this topic, consider subscribing, as this will help the channel grow and impact more people. Before moving forward, I want to mention that this video is for education purposes only and does not contain financial advice. I'm not your financial advisor, and whatever I mention on this channel is not taking into consideration your individual financial needs, risk tolerance, and time horizon. Now that we've got the legal part out of the way, let's dive in. It is bad news that your portfolio lost a lot of money, but in a recessionary market, that's not unusual. However, by selling your assets during this time, you lock those losses in. Instead, I would suggest finding ways to release the stress that is caused by your portfolio loss. It could be long walks, video games, exercises, yoga, watching these videos, whatever works for you. Anything to keep you from pressing the sell button. And if you really want to press a button, smash this like button instead for the YouTube algorithm. Subscribe to the channel and hit the notification bell to never miss out. As I mentioned in my previous video, a recession is a golden opportunity to buy, not to sell. However, before investing any money, you need to follow the steps that I mentioned in that video and make sure you are financially secure for your everyday expenses before investing any money into the stock market. If you haven't watched it yet, check it out now. Once you are your rational self, start creating a written plan for your portfolio and actionable steps to execute it. It is very important that you stick to it, otherwise what's the point? It could be dollar cost averaging into low-cost index funds or into your existing stock picks. Trying to time the market and wait until it bottoms should never be part of the plan, as it is impossible and you will be wasting your time. Past performance is no guarantee of future results, but it is still worth looking back at previous recessions to see how they played out. For instance, the most recent one in 2008. If you had invested in S&P 500 when it was dropping from $940 to $666 from October 2008 through March 2009, by early 2010, you would have made up your losses and started turning profit. Write down exactly how much you're contributing each period to each asset. The period could be weekly, bi-weekly, monthly, or quarterly. If you want to make any changes to your strategy, go through the process again and write down the reasons for the change. If possible, include in your plan different scenarios and your actions under those scenarios. This will increase accountability and induce rational thinking rather than emotional. You hear commentaries from different economists, financial analysts, that differ dramatically from one another, at times opposite views. That should tell you that nobody has a definite answer, only predictions based on analysis that may or may not happen. So you cannot act on every comment that is coming from news outlets. Instead, stick to your plan and be patient. Also, avoid checking your portfolio on a daily basis. Don't lie to yourself that you are emotionally strong and can bear the losses. It is hard to see your hard-earned money over the years to evaporate just like that in a matter of days. And feeling fearful and stressed is a natural reaction. It is very easy to give in just to stop the emotional pain. However, it is not rational and you will regret it shortly after. Avoid using leverage. I don't like it during good times, and during bad times it's an explosive. Don't risk everything for making a few extra dollars. With leverage, if the price of the stock falls below the broker's required value, a margin call is triggered, where the broker forces you to sell the stock at a low price to take their money back. The broker can sell the securities without your approval if need to. So not only didn't you have a chance to recover, but you also lost more money than you have invested. Be a smart investor, not a forced seller. You can do a little research to find a good buy, or just put your money in index funds that tracks the market. This is the time when you start getting defensive with your portfolio and look for companies whose stock prices are crushed by the panic sell-off. However, the businesses themselves are doing fine. Be cautious of what's called the value trap though. Companies that look cheap but whose businesses are worsening. Just because a company lost 60 or 70% of its value in the stock market doesn't mean it's cheap. Sometimes it just means the company is worthless. We will discuss how to spot those later in the video. Also, it is worth mentioning that investing in a recession is not a get-quick-rich strategy. There is a high chance that you will keep losing the value of your portfolio for months and years ahead. Nobody can predict how long the recession will last or the scale of the damage. Here are 8 things to look out for to identify dead companies walking. Number 1, high debt. Companies that use too much debt financing their operations would usually fall during difficult times. When the economy is slow, they're unable to generate enough revenue to cover their interest payment, which lead to insolvency. A recent example is Revlon, a 90-year-old cosmetics company that filed for bankruptcy last week because of too much debt on its balance sheet. During a recession and our supply chain issues that we currently face, suppliers usually demand upfront payment, and a cash-struggling company is unable to fulfill their request. As a result, they lose to a competitor who is well positioned and have the cash to pay for the suppliers and deliver their product to the market. That is exactly what happened to Revlon. They were unable to pay the suppliers up front and deliver on the products. Add to that their inability to catch up with competitors in social media marketing. This is only one example of how recession kills low liquidity and high debt companies. You can quickly check their debt to equity ratio to have an idea whether they have more assets or debt. The numerator should be much lower than the denominator, therefore the lower the ratio, the better. Next thing to look out for are companies that have unstable or cyclical demand. If the demand for the company's products is trendy and non-essential, it will fade off when a better product from a competitor comes along or recession drives demand down. These companies are not good investment, especially during a recession. Consumers have less discretionary income to spend on non-essential items, which will decrease the revenue of the company, which has a domino effect on the financial health of the company. Pay attention to companies' cash flows from their core business, excluding any cash from acquired companies. Steady profit is another component to consider. It must be positive and show growth. In a recessionary environment, it is a bad strategy to invest in speculative stocks that have negative earnings and price of the stock is tied to optimistic outlook for future earnings growth. They are the ones that go bust the fastest during an economic downturn. To extend more on profit growth, the company must also demonstrate an upward pace of growth. Here's what I mean by that and why it is important. For instance, a company has been growing at a steady average growth rate of 10% year over year for the past 5 years, which is good. However, for the next 3 years, the growth has decreased to 5% and 2% growth. The revenue will still show an upward trend and you might think the company is doing good. Nevertheless, the downward growth rate might be the sign that the company is slowly declining and not innovating enough. Going bust is not an overnight concept. There are signs that start showing early on, and if the company doesn't address them in a timely manner, it might just be the reason they fall. Another red flag is when companies constantly raise money, either equity or debt. In bad times, they run out of both and fail. A healthy company should be able to use their own funds generated from their business and invest in their growth projects or support themselves during economic downturn when demand is low. You should look for companies with positive cash flow that can sustain themselves in difficult economic times. If that is not the case, this signals bad management who focused more on their short-term goals and filling up their own pockets rather than the long-term health of the company. This will also artificially boost their cash flow statements, which could be misleading and overall bad investment. Pay attention to insider selling. Those who work for the company, especially the management, know more than any of us do. Of course, I'm not referring to small trades by insiders, which is normal. It gets alarming when frequent trades gets on the radar. If the CEO is selling, then so should you. Next thing to look out for is when a company is in distress and has no meaningful and clear path to profitability. Look for this under the 10 Ks, under management discussion and analysis. However, to avoid any fake promises and rhetoric, compare the previous MD&As and see if those were executed as promised. The execution doesn't have to be perfect, but the company should demonstrate improvements toward the goals stated. Number 7, companies that constantly acquire other companies will artificially boost growth and cash flow on their financial document. You don't have to know accounting to understand their schemes. Simply ignore them during recessions. Acquisitions are costly and exhaust companies' cash. In addition, historically, acquisitions don't deliver the desired synergies and often fail. Number 8, companies whose future depends on external factors they can't control do bad in a recessionary environment. For instance, regulations and changes in government policy can put companies out of business. Of course, all companies have external factors that affect their business. However, some have higher risk than others. What you need to pay attention to is whether that company has the ability and the means to pivot and reach profitability again. What I like to look at is, of course, liquidity, whether they have enough cash to fund the new direction. Another indicator is their management's openness to change, willingness to innovate, and the speed they execute. Past performance is usually a good indicator. And lastly, wanted to remind you about diversification. Diversify into different sectors and even countries. This will help reduce the volatility of your portfolio and give you exposure to different industries and economies. You can also diversify into different types of financial instruments you invest in. I talked about them in my previous video, including the advantages and disadvantages of each type to make it easier for you to decide which one you feel more comfortable with. If you liked this video, leave us a thumbs up, subscribe to the channel, and make sure you turn on notifications to never miss out. Check out my other videos on the channel for other money-making ideas you don't want to miss out on. As always, thanks for watching, and until next time. Diversify into different sectors and for future earnings growth. Invest in speculative the 5 and 10%. Oh my God!